Hey everybody, we have hand cam today, so I do apologize that you're not going to see my pretty face today, but that's okay because I'm going to let my hands do the talking because I want to show you a simple hand trick that's going to help you in your accounting career. Whether you're just starting out and accounting 101, you're just getting your toes wet in the accounting world, or you've been an accountant for decades, we all need to know our normal balances, which are going to be building blocks of journal entries. And well, journal entries are the building blocks of financial statements, and financial statements are the building blocks for management decisions and everything else. So if we don't know how to do journal entries, then our financial statements are at risk of being wrong. And if those are wrong, then management decisions are going to be wrong. And well, the global economy could collapse. Well, maybe not, but we do need to know exactly how journal entries work in order to do them right. And that's where this trick's going to come into play. You see, let's start with, again, a piece of paper. Now let's do what is known as the accounting equation, which in this case, I'm going to represent it as assets equal liabilities plus owner's equity, or in this case, ALO. Now, ALO is real simple to understand and to remember, which is great, ALO. And if you're pale and pasty like me, then, well, ALO actually comes in a whole nother benefit come summertime. So again, ALO for me is just simple to understand because again, assets equal liabilities plus owner's equity. That right here is the basis of our balance sheet. Now, owner's equity is a little interesting because there's actually two components of it that we can break out on its own, and that is going to be revenues and expenses. So in this case, Allo Ray. Now, personally, I wanted to name my daughter Allo Ray, but it was a battle that I wasn't going to win with my wife. So if you decide and have trouble that you're having trouble naming your kids, well, just know that Allo Ray is available and you're going to be doing the world of accounting a big favor. Now, here's what's really cool about these 5 account categories, because every transaction, every account that any business is ever going to do is going to involve at least one of these 5, regardless if you're just a small little lemonade stand at the end of your driveway or you're a multi-billion-dollar conglomerate. Every transaction a business is ever going to do is going to fall into one of these 5 categories. Now, to put this into context, every business should have a chart of accounts, which is literally just a listing of all the accounts that business is going to use in their books. Now, what makes it really interesting is you take all of those accounts, which again, if it's just a little lemonade stand, you're probably gonna have a handful. If you're a huge conglomerate, you could have tens of thousands, maybe hundreds of thousands of accounts. But it doesn't matter. Depending on even your quantity of how many accounts you have, they will all fall into one of these 5 categories. But guess what we also have 5 of? Fingers. So what we're gonna do is we're gonna associate each of our fingers with one of these account categories, and well, we'll just go from there. So to start, turn your thumbs to your left, so they're pointing to, well, your left, obviously, which means your pinkies will go to the right. Now we're gonna associate each of our fingers with one of these account categories, and we're just gonna go in order. So we'll go left to right. So in this case, our thumbs are going to be associated with assets, index fingers are liabilities, middles are going to be equity, rings are going to be revenue, pinkies are expense. So again, assets, liabilities, equity, revenue, and expenses. Boom. Now, I want you to take your left hand. Oh, I'm sorry, I didn't mean to say left. I meant to say debit. Because see, in the accounting world, debit means left and credit means right. So this is no longer our left hand, it's our debit hand. Now, what I want you to do is I want you to make a phone or a banana. I don't know what you want to call it. I used to call it phone when I taught this, but someone was like, oh, that's a banana tray. And well, that probably makes more sense. So again, whether it's a banana or a phone, just make this shape. Now, you're going to take your credit hand, get a nice little name tag for it, and I want you to make a 3. And that's probably not going to stick. So again, our debit hand is making a phone or banana, and your credit hand is going to make a 3. And right here is the hand trick. Looks pretty cool, right? Now what this is showing us is that each finger that's pointing up or down on its respective hand, respective to whatever account category it is going to show us our normal balances. So for example, our thumbs were assets, and it's pointing up on my debit hand, which means assets increase with a debit. Likewise, my thumb is pointing down on my credit hand, which means assets go down with a credit. So if we do our, let's say our ring finger, which is going to be associated with revenue, it's pointing up on my credit hand. So this says that revenues increase with a credit, but decrease when it comes to a debit. Now we do need to talk about the elephant in the room because this does not help with contra accounts. So contra accounts are accounts that are associated with, again, one of these, account categories, but they have an opposite normal balance. So these could be things like dividends or accumulated depreciation, because dividends is an equity account, which makes sense that it would increase with a credit, because again, equity is the third category. It's associated with our middle finger. It's pointing up on our credit hand. So equity usually increases with a credit, but not dividends because it's a contra account. So it's going to be opposite. So dividends increase with a debit. Likewise, accumulated depreciation is an asset, which tells us that it should be increasing with a debit because again, that's our thumb pointing up on our debit hand. But accumulated depreciation is a contra account. So it's going to be opposite. So again, that is something that you need to understand, is that when it comes to contra accounts, it's the reverse of what our hands are showing. So there it is. That's the hand trick. Just understanding what the normal balances are for each of the account categories based upon your hand placements here is going to help you. So for example, let's just do a couple of real simple examples. Let's say hypothetically we run a store, someone comes in and spends $100 of cash, and well, how's that going to look for us from the business standpoint? Well, we just received $100 worth of cash. Cash is an asset. If someone gave us $100, that's an increase in cash. So boom, there's debit to cash. And since we're selling something, we're going to assume that we do it for business, and so that's going to be revenue. In this case, cash is going to increase on our debit, and revenue is going to increase with a credit. So as another example, let's assume that someone paid us $200 today because they want us to come paint a room in their house next week. So, okay, so someone paid us $200 today, so that sounds like cash to me. So again, cash is an asset. We received cash, so it's an increase, so that's going to be a debit to cash. But let's assume we're accrual-based taxpayers. So we haven't earned this money yet. So again, it's not revenue because we haven't earned it yet. So unearned revenue is, well, to me, it sounds like a liability. Liabilities are our index finger, and since we received $200 and now we're obligated for $200 worth of service, that is going to be a credit. So in this case, debit cash for $200 and credit unearned revenue for $200. Likewise, whenever we go around to actually painting the room and we earn that money, we need to release the liability and exchange it for a revenue. So in this case, we are no longer liable, so our liabilities decrease. So in this case, our index finger is going down on our debit hand, so that's going to be a debit unearned revenue. Now that money has become revenue, so we're going to credit revenue because again, that's an increase. So just like that, any type of transaction you run into, just make these simple hand gestures and they'll kind of give you an idea of what exactly needs to be debited or credited for that specific situation. So hope that helps.